top, where we're going to find out more about embedded capital allowances and look at ways in which we can improve from a tax point of view. So today's agenda is we're going to I'll give you a very quick and brief overview of what we do at ATAF Partners for those of you who don't know us. And then we'll go straight into today's topic, which is going to be given by Pete Johnson and Luke Perry, who will give you a very decent overview of kind of how to improve the capital allowances that you can take back. And as always, there'll be a Q&A at the end. I would just say, if you have any questions, if you could put that into the chat, and we will answer them at the end. So for those of you who don't know ATAF Partners, we essentially offer a complete and rounded approach to financial planning, estate planning, and business consultancy, along with a wider array of professional disciplines that are delivered by our partners through our platform. We have a very much a collaborative way of working, which essentially streamlines financial strategies for families and businesses, looking to enhance both their prosperity and well-being, and also ensure that their legacy planning is in place to ensure a smooth transition of wealth across the generations. So essentially, we work with three types of clients: individuals and their families. So this is very much aimed at people who are looking at increasing and enhancing their wealth over their lifetime. It's directed at sort of, I suppose, what we'd call the mass affluent. And it's very much driven by financial planning. So ensuring that you have the right plans in place is fundamental to building on the capital that you can build during your working life. We use cash flow planning with everything that we do. It's a very, very useful tool to help people visualize where they are today, and more importantly, how they're going to get to where they want to get to. We also advise businesses, which is obviously probably more pertinent for most of you today. And we look at helping business owners and entrepreneurs, really ensuring that we can help them align their personal and their professional financial goals. And this is done through a sort of modular scheme. So we look at employee benefits, looking at ways in which we can help from a tax efficiency point of view, reducing costs, and also looking at advisory support through things like R&D tax credits. We've done a webinar on that previously, and we'll be having another one over the next couple of months on that. And then, of course, what we're looking at today, which is the capital allowances. And then our third type of client is, again, very much sort of aimed at entrepreneurs. But people who've either just gone through a capital event, such as selling a business, or are coming up to a capital event. The real difference between the private office and looking at individuals and families is that it's very much more driven by tax and the tax structure and architecture. So these are clients that generally have slightly higher wealth, slightly more complicated sort of assets that can be multi-jurisdictional, and they're looking at multi-generational wealth planning. So as I say, it's very much around the tax architecture. Of course, it still has all the bits that you might see in terms of the planning, the wealth management, and estate planning. But as I say, it's one layer above doing what the private banks would do. So if we just quickly go back to what we're looking at today, which is a business service. Obviously, today we're just specifically going to concentrate on capital allowances, but at ATAF we take its modular approach. So clearly we look at employee benefits, so pension planning, private medical, healthcare, those sorts of things that you would expect to look at. But the biggest the key to delivering a good business service for us is to ensure that the employees are fully engaged with the package that you put in place. Very often we find when we're reviewing businesses, they have employee benefit packages in place, but actually the employees either don't know what they are, what they've got, or they're just not really interested in it and don't engage. And in today's world, we can use all sorts of different tools. We are continually using more and more tech in order to make sure that you are providing the packages that your employees actually want and engage with. And essentially, the key to that is then helping you with employee retention. And equally, we look at helping the directors. So essentially, again, going back to what we're doing today, which is capital allowances, but also looking at different ways in which we can help with tax efficiency, and then things like EMI schemes, executive coaching. We work with a number of different executive coaches from both a director's level, but also actually can help with the employees as well. And we can run workshops from a financial planning point of view as well. So essentially making sure that the employees are happy with what they've got, and also that they are maximising their financial planning. Essentially, all of that helps to keep the employees happy and then and keep them retained within the business. So that's really a very quick overview of what we do at ATAS. And you can find out more on our website, which is just atas-partners.com. So going into what we are doing this morning, it's all about learning about what embedded capital allowances are and how they apply to your specific business assets. We'll discover which property and asset related expenditures qualify for those embedded capital allowances. And Pete and Luke will be able to give you a clear process to help you ensure that your business claims the maximum amount that's possible. Obviously, we'll have a bit of an update after the budget recently to see how that can impact on the claims that you make. And then they're going to give you some specific examples to help you understand exactly how successful claims can be made and how that can also then impact your business. So I will hand over to Pete and Luke now, who will obviously take over and be able to tell you all about what we're here for today.
Cheers, Daniel. Morning, everyone. My name's Pete. I'm going to talk you through a little presentation about embedded capital allowance and what sort of relief you can claim through the actual scheme itself. So I'm joined by my colleague Luke, who's a senior tax consultant. Luke's been in practice for 19 years. He specialises in research and development tax credits, capital allowances, land remediation. He's very, very good at what he does, and we'll work alongside you if we have a look at a property for you. So I just want to give you a brief introduction into capital allowances, because any accountant should be claiming capital allowances for you. So it was first introduced in 1878, and the intention was to provide tax relief for businesses on certain capital expenditure. Initially, the allowance covered depreciation of machinery, plant, helping business offset investment costs. Over time, the scope of capital allowances has expanded significantly to various different types of assets, including buildings, fixtures, and environmentally friendly assets. The structure and rules around capital allowances have evolved, especially with the introduction of different types of allowances, like the annual investment allowance, you might know it as AIA, in 2008, and the structures and builders allowance, known as SBA, in 2018. These adjustments reflect the government's ongoing strategy to encourage business investments and incentivise sustainable and growth orientation development in various different sectors. So We now move on to embedded capital allowance. Now, most people that we do speak to, when we say, have you looked into embedded capital allowance, they instantly miss off the embedded side and instantly think capital allowance, my accountant already does that. The question is, has your accountant looked at the structure of your building? Have they got out quantity surveyor? Have they gone to a company with a piece of software? We are finding 9 out of 10 buildings have not had a claim for the embedded capital allowance. So a type of relief in the UK that allows businesses to deduct a cost of certain capital expenditure from their taxable income, reducing the amount of tax that they owe. In certain cases, if you've already paid tax, you can also claim it back as well. So the embedded capital allowance refer to tax relief available on certain qualifying expenditures embedded within the building or structure. And we'll come on to exactly what qualifies under the actual scheme and also what buildings qualify under there. Unlike standalone machinery or equipment, there are assets integral to the building itself, but it's still eligible for capital allowance, providing significant tax savings to the property owner or the occupier. So when does it become important to you? So quite simply, if you are considering buying a commercial building, or you've already purchased a commercial building, or you're undertaking refurbishment or building extension work. Okay, now it's quite important that the property has been purchased after the year 2000. We have the software that can index link prices back to the year that you purchased the property. So we'll come on to property, what sort of properties qualify, and they can range anything from bed and breakfasts, hotels, public houses, care homes, petrol station and garages, warehouses, factories, dental clinics, veterinary surgeries, medical surgeries. Quite simply, if it is used for commercial, we can have a look at the actual property, but it has to be used for commercial use. There can be a split of commercial and residential within there, as is becoming more and more common these days, but we just need to do a split on the square footage within the actual building, but there has to be an element of commercial use within there. So what actually is an embedded item that qualifies for the relief? There are many items within the property that you just take for granted, you don't see. Things like the sanitary ware, hot and cold water systems, air conditioning units, electrical installations like fire alarms, lighting, your communication systems, telephone systems, security, thermal insulation, double glazed windows. They're all qualifying for embedded capital expenditure. The best way I always look at it, if you pick that building up, shake it around, empty, pour it up, put it upside down, everything that falls out is non-qualifying. Anything that stays in there, so your cables in the wall, your switches, they all qualify under there. So on average, you can get approximately 8% relief on your original purchase price of your commercial property. It isn't the price that it's valued at now, it would be the original purchase price. And everything would be index linked to that time, because as you can appreciate, if you bought a property in the year 2000, sanitary ware was an awful lot cheaper than what it is now. So, but the software that we've got with us will index link all that back. So to give you a couple of examples, if you purchased, and these are averages, so it depends on the complexity of the actual property. If you purchased a property for £250,000, you could gain up to £20,000 worth of relief there. 800,000, 64,000. So approximately it's 8% going across all the claims that we've managed to do and the industry have done. So there are two different ways that you can claim the benefit, and this is quite important. So if you have purchased the property within the last 24 to 36 months, we can look at the claim and you could potentially get back up to 2 years worth of corporation tax that you have previously paid. On top of that, you can carry any further relief going forward, and that comes in one lump sum, so you can carry it forward over the years to come. If you've purchased the property over 2 years ago, again, we can look at your last 2 tax years and see what corporation tax you paid and potentially claim the majority of that back. But then your relief is then spread over 10 years. So every year you get a chunk of relief to go towards any corporation tax, so you can go against any profits within there, and that works on a sliding scale over the 10 years. Some of the clients that we've dealt with only pay small amounts of corporation tax, not bought a very big building, and they just look at it and say, oh, I don't actually have to pay corporation tax for the next X amount of years, which is very, very nice. And the accountant says it's a bit of a no-brainer. But the one thing I will stress, we do encourage accountants to sit on the calls with you, so the accountant, who will probably know about embedded capital allowance but doesn't have the facility to service their clients with it, they can gain some more trust and know more about it as well. So what do we need to do to actually find you an estimate? First of all, you need to be a commercial property owner. Now, you can own it in the name of a limited business, you can own it in the name of a partnership, or you can own it as an individual. And it is quite simple. We just need a few documents and we can put together an estimate of what type of relief you can actually achieve from this. So it would be CT, if it's owned by a limited business, really simple, your CT 600 tax computation and accounts for the last 1 or 2 years, depending on when your year end is, and your purchase stroke completion agreement. That will then give us all the details we need to actually put together a estimate to show you what sort of relief you can get. Again, if you're a partnership, it is quite simply the tax returns, the self-assessments, schedules of data for partners, and the purchase and completion agreement. And if you own it as an individual, again, it's just going to be self-assessments, schedule of data of owner, and purchase and completion agreements. Now, we do have a couple of live case studies for you, and I've gone from one spectrum to the other, so you can see the sort of relief that we've actually got obtained for live clients. So, client number 1 owns 11 warehouses and shops all across the Midlands, and he's purchased them over various different dates since the year 2000. The total purchase price was £6.7 million when we've totted it all together, and we managed to obtain him £489,000 worth of relief. £120,000 of that was cash, where he's paid corporation tax through the actual company over a couple of years within there. Very, very happy client, and has also now referred us on to other people. We've also started working along with his accountant as well. We have another chap which is local to ourselves. He purchased a warehouse with offices on top. The total purchase price was £425,000. We managed to obtain him £26,432 worth of relief, which he can use moving forward. There was some small cash within there, but he'd only just started turning a profit, but he knew the next year it would have been a bigger profit. Now, what is worth mentioning at this stage is the relief that we can obtain for you, if it is in the name of a holding company or a business. If you are connected to other businesses, or you have other businesses that also have corporation tax bills, you can transfer this relief in between your businesses as well. So you're not having to pay corporation tax across your portfolio of businesses. Our process is quite simple. Obviously, we need to identify a client with a commercial property. Then we start talking. We then ask for the documents and we do a full file review. We then have a consultation call and we will show you what the breakdown within the estimate is. If you're happy with all that, we will then do our forensic survey using our bespoke software. And this uses Land Reg. It will also go off and index link everything back. It will offer a 9-page report as well, which will give you rebuild costs, and it will break everything down so HMRC can see this. And it is RICS approved, our software. We'll then review the documents with yourself, and we're happy to sit down with the accountant as well. We submit the report to HMRC and make the tax adjustments. If there's any corporation tax to come back from previous years, that gets paid out normally within a 2-week period, and the future relief will be sitting there on the amended documents. Nice and simple, really simple process. The normal process on this, from beginning to end, our side would normally take from a consultation anything up to 2 weeks. Thereafter, HMRC tend to pay that claim out within 2 weeks to 4 weeks, and it's all sorted. So it is a very, very quick process when it comes to HMRC. A couple of legislation changes that have happened over the last couple of years. One of the big ones is HMOs. Lots of people believe you can't claim through HMOs anymore. Isn't factually correct. They have actually just narrowed it down a bit. So you can only claim embedded capital allowances on the communal areas within a HMO. So i.e. shared kitchens, shared bathrooms, hallways, garages, anything that is shared within the property you can claim for. So if you had a room with an ensuite, within that room, that unfortunately wouldn't be claimable. It would have to be a communal area to claim on that. Another thing that HMRC introduced is properties bought after 2014 should have section 198 in the capital allowances section if you purchased or in your purchase or lease agreement. What we are finding is these figures tend to be not correct. Some people are just putting £1 in, and we can then go in and do an amendment to make that costing fair and just, nice and simple. But the one thing we are finding is the more and more we do, more and more people have just £1 in or £100 in, just because they don't know what to put in those boxes, which means your accountant potentially has claimed for £1 or not even bothered about it. It's not actually a true figure. We can go in with using our software and we can then adjust that.
And Pete, can you explain what a section 198 is?
Yeah, section 198 is just basically detailing the price of the detailed fixtures and fittings within the property at sale.
Okay.
Yeah. During the recent budget, changes have been made for furnished holiday lets. Okay. And that's removing the ability to claim for capital allowances, which unfortunately does include embedded capital allowances. As we're all aware, the government are trying to stop people from buying that second holiday home, which sits empty for 6 months a year, and making business out of it. And this is one of the ways that they've tried to actually stem that as well. But they're recent changes within there, but we're more than happy to sit down with anyone and talk through them. So just a quick summary, really. If you have got a commercial property, let's have a chat. We're more than happy to sit down, and all our estimates are given with no charge, no obligations whatsoever. We've already completed a wide range of properties on our portfolio. The software itself has already submitted 360 claims in what we've done. So we've got a tried and tested process. We've had one come back from HMRC, which says, how did you get to this price? And we just resubmitted the report to them. And they were like, oh yes, we didn't go to that page, which shows me how you've calculated everything. You can get previous corporation tax refunds. Most importantly, you've got that future relief moving forward as well. But yeah, the conversation will take sort of 15 minutes to see if you're eligible for the actual embedded capital allowance.
Very good.
Any
Thank
questions, anybody?
you.
I feel like I've just rambled on there.
Yeah, well, I've got a question. So the first one is, are there any types of commercial property that don't qualify?
Luke?
Hello, everybody. Yeah, so if there's been extensive renovations on the commercial properties, then we would have to look to reduce down what is potentially claimable. Essentially, what we're doing when a commercial property is purchased, we're going back in time, we're assessing what fixture and fittings were purchased and what fixture and fittings still exist. So yeah, if there's been extensive renovations, then we would need to discount everything that's been pulled out of that property since the time of purchase.
Okay. And then that links into my other question. Is someone able to claim relief for work that was carried out previously before they purchased the property?
Yes, but it would have to be done at the point of sale. So when the Section 198 is completed, it would essentially have to be included within that detailed election, and that's where the buyer would elect essentially the value of the fixtures and fitters and embedded capital allowances. So I think it's very important when people are considering purchasing properties to get a little bit of advice around the structure, what should be included in the share purchase agreement. And that's so important at the moment.
Okay, so it's a good idea for people to reach out to their accountant and say, look, should we take more advice to see whether there's something else we could claim on top of the standard claim, is what you're saying. Yeah.
Mm-hmm.
Yeah. Okay. Good. Gurmit, I'll come back to your question in 1 second. The other thing that struck me from your presentation, Pete, was, are there types of properties that tend to yield higher levels of embedded capital allowances than others?
Yes, there are. The more complex the property. So if you're looking at a hotel, there's a lot more pipework in the walls. There is more air conditioning units within the actual property, opposed to if you've just bought a storage warehouse, which is just probably going to have some electricity, running water, maybe some heaters. Care homes, again, if you have a look at the complexity of a care home, it's a much larger building, a lot more rooms. So the more complex a building is, the bigger the claim would be, and that 8% tends to shift more up to the sort of 15% of the property purchase price. Whereas if you bought a smaller warehouse, which is just used for storage, you're going to be dropping more to the sort of like 4% on there.
Okay. And also, does it apply to, we talked about, well, we haven't, but does it work for for leaseholders as well? Or just freeholders?
Yeah, no, it works for leaseholders as well. So there needs to be a significant financial interest in that property. And in terms of what we can do for the embedded capital allowances, it essentially gets treated the same as if it's a freehold purchase.
Okay.
So essentially, there would need to be what we can go in and claim on is the initial upfront lease premium.
Okay.
So not deposits, not annual rents, but there's got to be a premium upfront paid to secure that lease.
Thank you. Andrew, did you have a question? Sorry.
Yeah, no, you just asked it with regards to leaseholders, where clients put in. Are there any time restrictions with regards to the leaseholder? Are there any special, restrictions with leaseholders?
No. Other than the fact that they have to have a significant interest, financial interest, and there needs to be a lease premium paid up front.
Okay, and I had one of my clients has got a big, well, some residential properties, and he asked me yesterday, can embedded capital allowances be claimed on residential properties if they are used for business purposes, such as serviced apartments? I presume that's back to the commercial, the common areas again, is it?
Yeah. So when you say serviced apartments, is that like assisted living, or do we know?
I think it's more where people do very short-term rental, 3 days lets and stuff like that.
So essentially like an Airbnb.
Yeah.
Yeah, so we would be able to look at that.
You would?
Yeah, we would. So Airbnbs we can look at.
Okay, that's good.
I mean, it will all depend on essentially it will depend on the people that stay in there, how long they're staying for. as to whether it could be considered as commercial rather than residential.
Lovely. So, and Gurmit's put in the chat, how can you find out if capital allowances have been claimed on a commercial property that you are looking to purchase?
So that will be in the section 198 in the share purchase agreement.
Right.
So that obviously that was introduced in 2014. So anything after 2014 should have a section 198 election. However, we've seen a fair few contracts now, and they're not always completed. Anything before 2014, there was essentially no requirement. Essentially, the section 198 was brought in to effectively stop people transferring companies between each other, and reclaiming the capital allowances over and over and over.
Okay. So, but if they haven't got a section 198, you might not know, or it was before
Yeah, so
2014.
if there isn't a section 198 or there is a section 198, we would need to effectively have a look at what's in that 198, and then there may be certain things that we wouldn't now be able to claim on, but every property is different. So yeah, we would take it case by case.
Okay. So the conclusion seems to be pure commercial property, no problem at all. When we start moving into residential or holiday lets, the rules are tightening and there's more restrictions.
Yeah,
Yep.
as soon as there's residential use or planned residential use, then this is not possible.
Yeah. And there's quite a lot of visibility for properties that have been bought post 2014.
Yeah.
But some people presumably could have just put £1 in that section 198, and therefore you can still go back and say,
Yeah. There's potential for us to do that. Again, there would be certain stuff that would fall outside the scope because of that. But yeah, I mean, like I say, every case is different. And yeah, we'd need to review all documents before making a final assessment.
fine. I just had a connected question here about land remediation tax relief. Can you just talk to us about that quickly?
Yeah, fine. So essentially, that is all to do with contaminated land. So developers buying land that has got issues. What needs to happen for that to qualify? There would need to be a survey done on the land. It's quite in depth, because the way you claim land remediation is quite evidence based with HMRC. So there would need to be a report prepared by the relevant people to say these are the issues, and then you can only claim for the costs that are relevant in the years that you can claim for. So basically, you can go back 2 years. So your last 2 accounting periods are the years that you would essentially be able to claim on. But there would need to be a detailed breakdown of those costs. So effectively, any costs relating to putting that land right or making it as safe as possible. Because it's not always viable to get a piece of land back to spick and span. Yeah.
I remember at Close Brothers, they did a petrol station reclaim, and they had to sink all this stuff into the ground to soak up the something, and it turned into like an asphalt type thing. It took 3 years or something. Then they built a hotel on top of it.
Lovely.
Yeah, exactly. Gurmit, I hope that answers your question. Are there any more questions from the floor? Andrew, have you got any more?
I think that's me, actually. Yeah. Well, the other one we just covered, you've just covered was with regards to retail units, where there is it's split the residential, whether we can claim ECA.
Yeah. So obviously we'd need to do the section 198 checks and stuff first. But once we're happy that there is something there to go at, we would quite simply either need an insurance document to say, because usually within the insurance document you'll have a split between commercial floor space, residential floor space. If that's not available, then we would look at floor plans. Essentially, any residential parts would need to be discounted.
Right. And Gurmit's just come back with his asbestos story in the chat. So, well done. 16,500 square foot unit, which was full of asbestos.
When was that? When was that done? The demolish works.
We'll wait for him. There you go. 2022.
2022. Okay. I mean, that's something that we potentially could look at. We need to check out year ends, because essentially, like I say, you've got your last 2 year ends of the years that we can claim for land remediation. It's not something you can go back in time like the capital allowances. So yeah, they essentially would need to see the survey, and then you need to have a look at the specifics of what actually went on, why it was demolished. Obviously, you've said asbestos there. We'd need to check out whatever else is going on.
Yeah, but if you book a call, we'll jump on that. But I think we need to move quite quickly on that just because of the year ends.
Yeah.
Kermit, I'll give you a call after this, and we can arrange a call together.
Yeah, I think the overarching thing is if you're any of those 3 types of client, have bought, thinking of buying or thinking of selling, it's worth contacting just to see what is available for you to claim, and keeping up to date with what the sort of changes are.
Yeah.
So, well, thank you very much to all our speakers this morning. Thanks for your help, Pete and Luke. Thanks for everybody thanks for everyone that's attended. We'll be reaching out to you individually to follow up anyway, but if you'd like to email the 2 of us, we can put you in touch with Pete and Luke, and we look forward to engaging with you. Thanks very much.
Thanks, everyone.
Thank you, guys.
Cheers.
And we'll see you at the next webinar.
Yeah.